55 Capital's approach to active tax management. Investors are confronted with an increasing array of choices, whether it be what investment strategy to follow, what products to use, or how to get advice. The number of options is nearly endless. Yet, with all these choices, one thing is certain: taxes matter to most investors, and in a world where returns are low, taxes matter even more. While it would be nice if investment strategy and tax management decisions aligned, this, unfortunately, isn't always the case, and when they don't, investors need to make decisions. As an example, think about the investor who has a simple two-position portfolio that holds 60% equity, 40% bonds, and is looking to manage after-tax returns. If the value of the equity holding rises and the bond holding falls, such that the investor now has a 65% equity, 35% bond portfolio, she would be faced with the following three choices. Sell equity, buy bonds, rebalance to her target asset allocation, but realize a taxable gain. Sell bonds, buy equity, realize a loss, which can lower her near-term tax bill, but further skew her asset allocation. Do nothing, deviate from her target asset allocation, and miss the tax loss harvesting opportunity. At 55 Capital, we believe that investment decisions come first. By dynamically forecasting risk, but not returns, 55 Capital strives to outperform the static buy and hold strategy embraced by many investors. Adding active tax management to the investment process then provides the active tax investor with an additional opportunity to meet her investment goals. The 6 key elements of 55 Capital's approach to active tax management are: construct portfolios that are intrinsically tax efficient. Different approaches to investing generate different levels of near-term taxes. As an example, a momentum strategy, where one buys gainers and sells losers, will be inherently more tax efficient than a value strategy, which may look to buy stocks as they become less expensive, decline in value, and sell stocks as they become more expensive, increase in value. Understanding and incorporating these differences, when both strategies seem attractive, creates portfolios that are inherently more tax efficient. Take advantage of a broad array of asset classes. A key component of the 55 Capital approach to managing assets is to incorporate a broad set of asset classes. Having granular exposure to a broad range of asset classes allows for a variety of tax loss harvesting opportunities given the dispersion of returns across asset classes. Use tax-efficient investment products, ETFs. Exchange-traded funds are powerful tools for managing taxes as they infrequently distribute capital gains relative to mutual funds. Thoughtfully select ETF proxies. The investor's goal in tax loss harvesting is to find a replacement security or securities that has or have nearly identical characteristics to the security being sold. This is very difficult to do using mutual funds when there is not enough real-time transparency about what you own, or with individual securities where individual companies simply don't have good substitutes. It can be done, however, using ETFs. Of course, some ETF investors do this using a fairly simplistic approach, i.e. substituting out S&P 500 exposure with Russell 1000 exposure. However, this simple approach doesn't always work, given the best proxy isn't always a single ETF, and that the markets are dynamic, i.e. correlations between various ETFs can change over time. 55 Capital's approach is to continually evaluate proxy selection to identify the most efficient approach to replacing ETFs when implementing tax loss harvesting. Deliberately identify tax lots. Tax lot accounting matters because it determines the size of both realized gains and losses. While there are multiple approaches to tax loss identification, 55 Capital believes that HIFO, highest in, first out, delivers the most value, as it allows investors to recognize the lowest level of gains and the greatest level of losses. Actively harvest tax losses. For many, tax loss harvesting is an end-of-year exercise. However, This approach has the potential to miss the many opportunities that exist for tax loss harvesting between January 1st and December 31st. As an example, in 2015, the S&P 500, as measured by the SPDR S&P 500 ETF, went from $205.54 per share at December 31st, 2014 to $208.69 at November 30th, a 1.5% gain. However, an astute investor watching the market would have seen the ETF priced at $199.45 on January 30th, thereby creating the opportunity to generate a 3% loss. At 55 Capital, we look for opportunities to harvest tax losses monthly in order to create value for the investor. Implementing these 6 elements in a systematic and scalable fashion is integral to the 55 Capital approach to asset management.